So you've got an interview coming up, and you know they're going to ask about global accounting standards. Well, you are in exactly the right place. We are going to walk through everything you need to know about converting from US GAAP to IFRS. We'll cover the big picture strategy, the nitty-gritty numbers, everything you need to sound like you've been doing this for years. Let's dive right in.
First things first, let's start with a question you are almost guaranteed to get right off the bat. Why would a company even bother doing this? I mean, it's a huge project, right? And it is. But understanding the why shows your interviewer you get the business strategy, not just the accounting entries.
And the answer is never just because we have to. It's always a strategic decision. Maybe the company wants to raise money in Europe or Asia, where capital markets demand IFRS. Or maybe they were just bought by a foreign company that already uses IFRS. Another really common reason is they have a parent company that's based overseas. The big takeaway here is that this is all driven by major business goals, things like global expansion and M&A.
Okay, so here's our game plan to get you ready. We'll nail down the strategic why, then we'll get into the core difference between GAAP and IFRS. After that, it's all practical stuff, the 4-phase plan, the key number changes, and the final reports you have to produce. And then we'll wrap it all up with the exact talking points you need to ace that interview.
So let's jump into our first section, why companies make the switch. And honestly, this subtitle says it all. This is so much more than just an accounting change. In fact, one of the biggest mistakes you could make in an interview is to treat this like it's just a job for the accounting department.
See, a successful conversion is a full-blown finance transformation. It impacts, well, everything. You're talking about redesigning business processes, changing how data flows through IT systems, and rewriting your internal controls. Interviewers are looking for people who see that bigger picture. They want to know you understand that one little accounting change can send ripples across the entire company.
All right, let's get to what is probably the single most important concept today. If you get this one idea, this core philosophical divide, then all the technical details we talk about later, they're going to make perfect sense. This is the bedrock of your IFRS knowledge.
This slide lays it out perfectly. Think of US GAAP like a super detailed recipe. It gives you precise measurements, step-by-step instructions. There's not a lot of room for creativity. IFRS, on the other hand, is more like a guideline from a master chef. It tells you the principles of what makes a great dish, but it trusts your professional judgment to pull it off. Now, the flip side of that trust, you'd better document everything to justify the decisions you made.
And this quote, it just nails the potential downside of a purely rules-based system. When you have thousands of pages of specific rules, some people might try to find clever loopholes. They follow the letter of the law, but completely miss the spirit of what the rule was trying to achieve. Mentioning this kind of nuance shows a way deeper level of understanding.
Okay, so we've got the why, and we understand the core philosophy. Now, let's talk about the how. How on earth does a company actually manage a project this big? Well, it's not just chaos. There's a well-established blueprint, a plan for making this transformation happen smoothly.
The whole thing usually breaks down into these 4 phases. It all starts with phase 1, the diagnostic and gap analysis. And honestly, this is the most critical stage. It's where you dig in and identify every single difference between your current GAAP policies and what IFRS requires. This takes a good 4 to 8 weeks, and it really sets the foundation for everything else. Designing the new systems, building them, testing them, and finally, running both GAAP and IFRS side by side for a while before the official go live.
All right, now for the fun stuff. This is where we get into the details that are going to make you sound like a total pro in your interview. We're moving from theory to practice and looking at exactly how the numbers on the financial statements actually change. We're going to focus on 3 classic examples you absolutely have to know.
First up, inventory. US GAAP allows this method called LIFO, last in, first out. It basically assumes the newest inventory you bought is the first stuff you sold. Well, IFRS just says, nope, you can't do that. It's strictly prohibited. Under IFRS, you have to use either FIFO, first in, first out, or a weighted average cost. For a lot of US companies, especially in manufacturing, this is a huge mandatory change. So, what does this actually do to the numbers? Well, the company has to get rid of something called the LIFO reserve. That's the running total of the difference between the LIFO and FIFO values over the years. When you reverse that reserve, as you can see here, it usually lowers your cost of goods sold, which of course directly boosts your pre-tax income.
And we are not talking about chump change here. In this example, just this one accounting adjustment adds $3 million to the company's income. This is the perfect kind of example to have in your back pocket for an interview. It's clear, it's quantifiable, and it proves you understand the real-world impact. Let's move on to our second key adjustment, development costs.
Under US GAAP, you typically expense these costs as they happen. They hit your income statement right away. But IFRS looks at it differently. It actually requires you to capitalize these costs, turning them into an asset on your balance sheet, as long as they meet certain criteria for being commercially viable. You're literally taking a period expense and turning it into a long-term asset. And just like with LIFO, this can have a huge effect on your profit. By capitalizing $2.5 million in costs that you would have otherwise expensed, you add that exact amount back to your pre-tax income for that year. Now, the key here is that the expense doesn't disappear forever. You're just spreading it out over future periods through amortization. It's what we call a timing difference.
Okay, now for a pro tip. Listen up, because this is a classic interview trap. It's a really subtle difference in how you classify debt, but it has a massive impact on key financial ratios, specifically the ones that measure a company's liquidity.
Let's walk through this timeline. Imagine a company has debt that's due on December 31st. Under IFRS, the rule is simple. On the reporting date, that debt is short-term, so it gets classified as a current liability. End of story. But under US GAAP, there's a little wiggle room. If the company manages to refinance that debt after year-end, but before they officially issue the financial statements, they can reclassify it as long-term. IFRS doesn't allow that. This means an IFRS balance sheet can show higher current liabilities, which can make things like your current ratio look worse.
Okay, so we've made all these adjustments. We've reversed LIFO, we've capitalized development costs, we've reclassified debt. How do we pull it all together and actually present it to the outside world? Well, that process is governed by a very specific standard called IFRS 1. Think of IFRS 1 as the official instruction manual for making the switch. Its main rule is something called full retrospective application. It's a fancy way of saying you have to create an opening balance sheet that looks as if your company had always been using IFRS. Yeah, it's a huge job of restating past financials, but there are some practical exceptions to keep it from being impossible.
And the most important thing IFRS 1 requires is transparency. You can't just drop the new IFRS numbers on people and walk away. You absolutely have to provide detailed reconciliations that build a bridge from your old US GAAP numbers. You have to show investors and stakeholders exactly how and why your equity and your income changed, explaining every single major adjustment.
Phew, we've covered a ton of ground. So now, let's bring it all home. Let's distill everything we've talked about into the key talking points you can use to structure your answers and absolutely ace that IFRS interview.
Here's your game plan. Think of it as a 4-step answer. Start high level with the philosophy. It's a shift from rules to principles. Second, show your business savvy by framing it as a strategic project, not just an accounting chore. Third, get specific. Give them concrete quantitative examples, like the LIFO reversal or capitalizing development costs. And finally, show them you know the endgame by mentioning the mandatory IFRS 1 reconciliations. This structure proves you get the whole picture, from strategy all the way down to the final report.
And we'll leave you with a final thought to chew on. We've spent all this time talking about the differences between GAAP and IFRS, but the much bigger trend is that they are slowly coming together. As money and companies move more freely across borders, is it only a matter of time before we have one single set of accounting rules for the whole world? It's a great question to think about, and it shows you're thinking about the future of finance. Good luck with that interview. You're going to do great.